This is the current federal tax developments for the week of December the 26th, 2023. Current federal tax developments are brought to you by Kaplan Financial Education and by your state Society of CPAs. Med Zollers here on the Boxing Day version of the current federal tax developments for this year, and the final version we're going to have before we get into 2024. And we do have a couple things to discuss this week, even though it was the week before everybody went on a holiday. There was one very big development during the week, and that is that the IRS announced a 3-month employee retention credit voluntary disclosure program. This was the second program in the series that they promised back on the September 14th suspension of the program, processing. So we'll talk about what the options are there. As well, the IRS provided relief from failure to pay penalties for 2021 and 2020 taxes in certain situations. We're going to talk about that due to the IRS ceasing to send out notices or automated notices of payments due. They are now going to start restarting that program, but they are going to waive certain failure to pay penalties during that period because reminders weren't going out. And then finally, we have a taxpayer who violated a technicality, but it's somewhat important. The taxpayer used the wrong FedEx service to file his tax court petition. Now, the same thing would be true if you did a return via that method, where you use a private delivery service. But in this case, he lost his chance to challenge the IRS assessment in tax court simply because he used a service that wasn't on the IRS list. And we'll talk about the importance of that, some of the prior issues that have come up with that in the courts, and just what you need to be careful about when dealing with this area. But let's start with the IRS's voluntary disclosure program for the employee retention tax credit. Now, there are really three parts of this. We have announcement 2024-3. We have news release IR 2023-247. And we have new form 15434. And all of these came out on December 21st, along with a set of FAQs about the program. Now, the IRS had promised to add a program for those who had received a refund under the employee retention credit, but now believe they didn't qualify. You remember we had previously talked about, and this has been out for quite a while now, a program to withdraw your claim. Now we got a program to pay back whatever you got that you now decide, hey, we shouldn't have gotten that, right? We don't think we qualify. We now have paid attention. We've talked to our advisor, and we now believe that we probably didn't qualify for that credit, but we don't really have all the money to send back with interest and penalties. And so we're going to talk a little bit about what the options are the IRS has given you here. This program is called the Employee Retention Credit Voluntary Disclosure Program. If that voluntary disclosure program bit sounds familiar, yes, the IRS has had these in the past, specifically for offshore bank accounts. And so the nature of these programs is something where the IRS generally starts a program, and this will run only through March 22nd of 2024. And what they do at that point is they offer what's generally their most favorable deal if you come in early. So generally what will happen is, it's not that it's on March 22nd necessarily. They're no longer going to let you come back in from the cold, and they won't give you certain breaks if you do. But generally, you get the best deal under these voluntary disclosure programs if you come in early. So we would expect that when you get to March 22nd, that some of the niceties of this program will go away, and you'll end up being stuck with paying back more significant sums. So the idea here is to suggest to you that, you really want to come in from the cold and do so now, that will be in your best interest. And this is a fairly good deal if you can scrape the money together to get it done. And you believe that your credit should not be allowed, that you've talked with other people besides the people that got you into the credit. And they're very skeptical that if you get examined that you'll survive, and you've decided, oh, I just don't want to play that game because it can be a very dangerous game. So that's part of the deal with doing this as to why you would come in early. But it is an all or nothing, which makes it a little bit tougher to make this call. And just to give you some incentive, the IRS announced at the same time that they are beginning to send out an additional 20,000 letters with proposed tax adjustments. Now, what that means is these are people that have gotten refunds. Remember, the first set of letters we talked about a week ago was only a set of letters going out to people where they had applied for the credit and they were just being disallowed and saying, nope, we don't think you qualify. We're not going to send you the money. Now we're going to convert that over and start going and assessing tax. This obviously is meant to be an incentive because there's no guarantee that if you wait until March to make up your mind on whether you come into this program, that you won't get one of these letters ahead of time. And by the way, bottom line, as we'll discover, if you've gotten one of these letters, you are no longer eligible to enter the program. So the idea is don't wait, do it now. That's the concept of the service. At least that's their threat. Now, the carrot in the program, which is why you'd come in, is that if an employer comes into this program for the quarters, they say, hey, you know what? We don't qualify for the ERC. It's got to be totally, a total idea of saying, hey, we're just going to give up the entirety for this quarter. If you do that, you only need to pay back 80% of the credit that was paid out to you in the refund. So if you got a $1 million refund, you would pay back $800,000. The IRS reason for this, and they tell you this in a news release, is that they're aware that a lot of people paid various promoters and they paid them a contingency fee that was based on the amount of credit they received. The problem is, even though they received a $1 million credit, they had to pay, let's say, 20%. In a perfect world, it would be that. So we're evening this up. So they paid back 20%, so they paid $200,000. Now, one problem with that is some of the better known programs, the Wall Street Journal reported Innovation Refunds, was charging 25%. So if you were in their program and now you believe you don't qualify, then you're going to eat the 5%. But there's another really important advantage to this program. You get a full income tax deduction for all related wages. And secondly, which we'll point out as well, you end up not having to pay back any of the interest they paid you, when they gave you your refund and paid you some interest on the refund claim. But conversely, you also have to pay them interest on the amount that you now owe them back. So, yeah, there are some advantages. And so even if you did pay 25%, you might still find that with not having to deal with the interest side of this equation, you're still money ahead going down this program. You at least mechanically break even. Obviously, a big problem is if you've spent the money, well, yeah, you probably don't have it in the bank. So that could make it more interesting to come up with that $800,000 check. But we're just going to talk about this program as it stands right now. To be eligible for the program, you have to meet a few requirements. So these are the initial eligibility. You cannot be under criminal investigation, and you cannot have been notified the IRS intends to commence criminal investigation. That kind of makes sense. If they're criminally investigating you, gang, hopefully you've got attorney, you got legal counsel in play right now. Let's go down that path. The second one's more interesting. The IRS has not received information from a third party alerting the IRS to your noncompliance, nor has the IRS acquired information directly related to the noncompliance from an enforcement action. Now, this will be interesting because part of this deal, as we'll discover, is you're going to turn in information about the promoters. It is possible that the IRS might seek to obtain information from those promoters, and while March 22nd is a very short time frame for that to happen, it's always possible. So again, it's better to go in early. Also, obviously, the longer you wait, the more likely they will run into something that would tell people that, hey, this particular employer might not have qualified for the credit for various reasons. You cannot be under an employment tax examination by the IRS for any period for which you're applying for this voluntary disclosure program. So I would read that to mean if the IRS has said, hey, we're examining your claims in 2020, you got a new claims in for 21, you could, maybe your claims for 21 were paid, but they're only examining 2020 at the moment. You could go in for 21 if you wanted to. And a participant has not previously received notice and demand for repayment of all or part of the claimed ERC. Right? So basically, yeah, once you receive a notice, you're done. Now, the one problem with that third category, where if you're not if you're under exam in another period, coming in for this period might be tantamount to confessing, that you were not qualified for an earlier period. So yeah, that could be kind of an interesting problem. So definitely, I would not blindly go in that situation. I would make careful consideration and also discuss your idea of how you're going to handle the exams that are currently in play, because that question is going to probably come up. Uh, third payer comp. If you have third party payer, as the IRS had mentioned earlier, this does complicate matters, but they're a little clearer this time. If you use the third party payer's EIN, then the process must be initiated by the third party payer. So that means, like if you're using a professional employer organization and the W-2s are being issued with the EIN of the professional employer organization to the people that work for you, then you're going to have to go through them to get this done. And in that case, they're going to have to do a special filing. If they filed, like they're a payroll service, but they filed a separate 941 for you and separate W-2s, then you can enter into the program on your own. You don't need the third party payer to assist you, right? Now, the terms of the program, how do we make this work and what happens? Let's talk about that. First, you have to say that you're not eligible for or entitled to any ERC, including both the refundable and the non-refundable portion for the tax period or periods at issue. So let's say that you're not qualified for the first quarter of 21, but you believe you did qualify for the second, third, and fourth quarter. You would have to totally give up 21. So this becomes an interesting problem. What if you're eligible in the first quarter, but you're not sure you're eligible for a whole lot more than 25%? You might, or 20%, you might arguably be better off by, saying, hey, we're not eligible at all. Because remember, you're also going to get the benefit of not having to wipe out that income tax deduction for the wages. So this one's more interesting. But what it does mean is, let's say that you've reviewed the quarter. You've had an outside CPA, an outside CPA, outside EA, whoever reviewed the quarter. They independently have looked at this now and have determined that, well, you claim a credit of $100,000 for this quarter. In reality, your credit should have been $70,000. You do qualify, but you don't qualify for as much because, let's say, whoever prepared it didn't take care of the PP offsets, didn't do other things right, didn't limit wages, various other things, or just frankly, their theory is dead wrong, but you had a perfectly good alternative theory that would get you in, but you don't qualify for as much. You cannot go in this program for that quarter. You would have to file a revised 941X, and that goes back on the FAQs of the ERC program, which they told you about when they talked about withdrawing your claim. The same issue there, and the same advice would apply. You're just going to essentially have to file yet another 941X, revising the last one. You will remit back to the Department of Treasury 80% of the claimed ERC, including both the refundable and non-refundable portions. So basically, as I said, if you got $1 million for the ERC, you're going to go back $800,000. You will remit that quarter by quarter. They are going to be very clear that each, you don't make one big lump payment, right? You're going to make, each quarter is going to go in on its own. They're strongly noting you should go on a quarter by quarter basis. Otherwise, it may not work. Now, this is a very nice provision. You're not required to repay any of the overpayment interest you received. As long as you make the full repayment of the 80% of the claimed ERC prior to executing the closing agreement, no underpayment interest will apply as well. Now, if you go for an installment agreement, then you're going to find there may be interest and penalties to get on top of this. The IRS is strongly recommending that you go out and find somebody, find a third party to borrow the funds from. But you're going to be better off doing that than trying to get an IRS installment agreement. They are kind of discouraging the installment agreement option. They'll talk about it because I think some people will have no choice but to go that route. But it won't be as nice for you to go the installment agreement. They're definitely suggesting that if you can find outside sources of funds, you find the outside sources of funds. The income tax effects are also very nice. Because essentially it eliminates your eligibility or entitlement for the claimed ERC. You're not required to reduce wage expense with respect to any of the previously claimed ERC. Consequently, If you had not previously reduced wage expenses by filing an amended return or an AAR, administrative adjustment request, then you don't need to do so, right? You don't need to put that back in. If you'd already reduced the wages, let's say on the original return or on an amended return, you can file a new AAR or amended return. Now, I think this is part of the reason why this whole thing cuts off in March. They're recognizing that the statute for the amendment and getting the money back, the refund, that's going to run out basically at March 15th for some of these people. So you still got to make sure you're in statute. Obviously, if you'd extended, then we're probably better off. The individuals had extended, but be aware of those issues, as well as the AAR. And finally, you don't pick up any income. So not only do you get to deduct the full wages, even though you're keeping 20% of the ERC, not only do you, basically have no interest in anything on this, but we're not going to treat that amount you did receive as taxable income. So that's not going to be a problem. Now, not clear here is what they're going to do about the amount you paid the third party. I'm thinking they're not going to worry about that. They're going to allow the deduction because they never mentioned it if you paid a consultant. But there is a potential background issue here of, well, wait, now that is a payment related to tax-exempt income, is that deduction now disallowed? That's a little different. They don't say anything about that. I don't think they're going to go that route, but it is something to think about, at least theoretically. Now, here's the big catch. If a return preparer or advisor assisted or advised you, and I like they're going for both assisted or advised, because we know a lot of the flakiest of the mills essentially would avoid being the preparer, so they're not on there as a preparer anywhere. So it's anybody who assisted you, either way, shape, or form. So if you had a third party who came in and did the ERC study, but then you had another firm that came in and did the did the actual 941X, then basically you're going to turn in both of them. You're going to be talking about all of them. So that whole thing, if it was one of those arrangements, it was kind of like what we saw here with, so that means if you had somebody like, like Innovation Refunds per the Wall Street Journal, basically they were just the front end who got you marketed on it, but then they brought in a law firm that would, some attorney that would take care of the actual filings and the study, quote unquote. I would believe under this program, you would have to turn both of those in because, ERC had, Innovation Refund had assisted you, and then the other firm had done it. Okay. So again, if you had a program like that where you believe, that, you're now saying, hey, I'm just going to go into this program. I'm not going to take the risk of an exam. You'd have to turn in all parties that were involved. So if you had one of those where you had a marketing group that then just brought in a study firm who did the 941X and you had somebody else do the 941X, then you're going to name all three. That's going to be the background. That is a requirement. They have to provide the name, address, and phone numbers of preparers or advisors who assisted with the credit of refund and a description of the services each provided. Obviously, the IRS is using this to help them investigate some of those programs and maybe surface some that went over the top. So that's the reason for this requirement as they're looking at it. Penalties, they will not assert civil penalties related to the underpayment of employment tax attributable to claimed ERC against a participant voluntary disclosure program under this announcement. But the caveat here is that remits payment of the 80% of the claimed ERC prior to executing a closing agreement. And if you go for an installment arrangement, then things might be different, right? You may have different issues. And they keep mentioning this because they are really going to, what they don't want to do is enter into installment agreements that never get paid. So, yeah, if you go the installment agreement route, don't be surprised that you need to pay up. You also will execute a formal closing agreement with the IRS. Closing agreements are final, right? So this definitely means when you say, hey, I don't qualify for the ERC in the, in the first 3 quarters of 2021, and I want to pay that back. No changing your mind, right? None of that stuff with a closing agreement. That year is done. It will close down the IRS's ability to go after you, but it will also, eliminate the ability or your ability, to go back later and try to claim against that period. So you're going to be there. We also don't know. You're going to have to watch the terms of that closing agreement. That'll also be something to watch carefully. Obviously, they're not publishing a draft closing agreement here. They're probably going to tailor it to each situation in some way, shape, or form. But you're going to want to carefully review that agreement. And again, it's all going to be kind of interesting. So we'll take a look at how this works. Like we say, they went on and said they were not going to charge you interest or penalties. However, if you're unable to pay the required 80% the same time signing agreement, then it'll be required to pay penalties and interest in connection with entering into an installment agreement. So, bottom line, yeah, they're encouraging you to find other places. Don't just go to the IRS and beg and say, "Hey, I need an installment agreement." If you got some other way to do this, they're really suggesting you use that other way to do it. Now, the procedures are going to file Form 15434, the newly created Application for Employee Retention Credit Voluntary Disclosure Program form. You'll include the name, EIN, address, and daytime phone number of the, of the party applying for the, to get in the program, along with a Form 2848 for the power of attorney if you're being represented by a practitioner. So if you're going to represent one of your clients, in this case, you'll put the 2848 in with this form. You'll also identify the tax period or periods for which it's claimed, the form on which it was claimed, and the amounts, refundable or non-refundable. That's in a schedule attached. Basically, as part of this, they've got that in play. You must consent to an extension of the statute if any 2020 claims are involved. You're going to file this program and you're going to try to bail out 2020 claims. You have to open up the statute for 2020. Remember, that statute was set to close on March 15th of 2024. Now, that statute closing may or may not make a difference. Your actual statute, if you only filed your claim, sometime in 22 would probably still be open until later in 24, but IRS doesn't care. If you got a 2021, you're going to open the statute up until we get this thing resolved. So you're going to have to file that form along with the 15434. Okay? And a third-party payer, if they were used, when they put it together, they're going to have to attach the appropriate Schedule R, Form 941. Relevant pages will be part of the form. That will be there, and that'll be part of what will be attached. If you go to get this form, you go using the links we have, you are going to find, like if you've not set up Adobe Acrobat to be the thing that displays PDFs in your browser, and I don't do that. I don't like, putting in those add-ons to the browser. So I just go ahead and leave the standard browser routine in there, the standard browser PDF display, because for me it's perfectly fine. You will probably be told that it just look like it's just a one page that tells you have to use Acrobat. That doesn't mean you have to let Acrobat be the PDF program that is used to display in your browser. What you can do at that point is download that. That is some front-end script running in the PDF that simply hides the PDF. And what you can see, because they have fill-in forms and computations in it, that hides that PDF from you if you don't bring it up in Acrobat. But if you download it onto your own drive and then open it up in Acrobat, either Acrobat, the full Acrobat, or the Reader, as long as you have version 8 or later, you will be able to then fill in the form. And you probably want to have a copy of this form there anyway, because you are going to want to download it and keep a copy if you actually file the form. So yeah, you want to go ahead and download that. Just use the download option in your browser. There's usually a little down arrow when it's displaying the PDF. Somewhere on the screen, it's in the upper right on the default PDF display in Chrome. And then just download it to your machine and then put a copy of that somewhere that you'll just use it if you have any clients that are coming to this program. Okay, as we said. Now, as I said, if a return preparer advisor was involved in the claim, you're going to put the details in Part 5. And Part 5 looks like this. So you'll see it's going to ask you, and you're going to have to do one of these for each advisor. You're going to be a whole series of these. And the way the form's set up, part of the reason why you have to use Adobe is, at the bottom of this, there's a little button that says, do we need to add another? And so just keep adding these Part 5 entries, the first, second, third, fourth, etc. It'll ask you, did an individual, business, or organization advise you to claim the ERC? If the answer is no, you literally just, the company did it themselves, then check no, and then go on. Now, by the way, if they did it themselves and they screwed this up and they claimed it when they shouldn't have, the funny part, the interesting part is they're still going to get to keep 20%, even though they didn't pay a fee. So that's kind of interesting. But don't be surprised if the IRS gets a little interested and might ask some questions, because I'm sure there's going to be people that'll mark no because they just don't want to be interviewed by the IRS, potentially drawn into, if they go for, let's say, criminal charges against some of the parties that were involved, they wouldn't want to be part of that. If you come into this, that's all a that's a possibility you might be pulled into that. So be aware of that. And again, if they find out that you didn't give the advisors who worked with you, then that would be considered a fraud, and that would basically blow up your voluntary disclosure program, and now they'll throw the book at you. So yeah, answer this question honestly. That'll be important. You need to give the name of the preparer advisor, the company or firm name, telephone number, address for them, right? And then describe their services. And you'll do that for each of the ones that worked with the particular client that is now trying to pay back the money, right? Now, your payments on the program will be made via EFTPS. And you do want to make it separately for each tax period. The IRS specifically warns you against, don't do a lump sum. The category you're going to pick is advance payment. They'll describe that in there. The full payment should be made by the date of the closing agreement. Installment agreements can be requested. But as I noted, the IRS is strongly recommending not. So in theory, you would go in, you'd make the EFTPS payments effectively at the same time you execute the closing agreement. The IRS will send you a closing agreement. You would do that. And when you're in the program and accepted, you would make the payments and execute the closing agreement. The actual form computation is really just looking quarter by quarter. You'll see there that, it just asks you for the form you filed it on. It asks you for the non-refundable and refundable, so you got to get that off the forms. And then it just goes ahead and it computes a 20% reduction. So in this case, you would see that overall they had $210 of credit, but they're going to get to keep $42,000 of it and pay back $168,000. That would be their payment in this issue. Now, this form must be submitted to 15/4/34 by 11:59 p.m. local time on March 22nd, 2024. And that would be presumably local time of the employer. So you want to make sure you get that right. I wouldn't wait till the last second, but that's the date. You are going to upload this. You don't mail this form in. You must upload it via the document upload tool at irs.gov/DUT. That's how you're going to do it. There is a very specific document assembly requirement that's in the notice about exactly how you just order these up and put them in and what's to go with this packet. You want to make sure you get that right. And there are additional instructions for amending a previously submitted Form 15/434 found in the instructions to 15/434. So if you submit this and then discover, you filed it up, you put the wrong number down, or something else was wrong, there is a way to amend it if you want to. And the closing document must be submitted back to the IRS within 10 days of the date of mailing by the IRS, not the date you receive it. You will not have 10 days to make your decision. You're going to have 10 days from the mailing date. So that would probably, maybe give you a week at best to be able to, finally sign the closing, study the closing agreement and sign it. Right? I'd bet on that. Now, there are some not so great additional terms you need to worry about here. You have no right to appeal judicially or administratively an IRS denial under this program. Now, whether or not you really have judicial review is something that, if you want to litigate the question, you can try. There has been some discussion about whether the IRS is still subject to an abuse of discretion standard when they put out a program like this, but They're saying you have no judicial review and there's no administrative appeal. And even if there was, like I said, on the off chance you can get it to court, it's going to be abuse of discretion because nothing in the law requires the IRS to do this, right? This is a program they're offering a deal, right? This is their voluntary disclosure program to get you in. And the other one, which is now the more concerning of the two, execution of the closing agreement under the voluntary disclosure program does not preclude the IRS from investigating any associated criminal conduct or recommending prosecution for violation of any criminal statute, and does not provide any immunity from prosecution. So while the civil penalties are off the table and you're not going to be paying interest, if they discover, they decide it looks bad, you may still be criminally liable. Now, this is a bit of a concern just because you're going to give them a lot of data. And you submitted that data and information. And, certain things may come up. I think especially I'm going to see some people that are trying for installment agreements might get themselves in trouble because an obvious question the service is going to have is, well, what happened with the money? And I remember at the AFIT, Arizona Forum for Improvement of Taxation conference this summer, representative from the basically the CID was pointing out, she noted that for prosecution, what they like, because they know juries will go after these, are cases where people spent the money on luxury goods, right? They went and bought fancy cars, they got a home, they did various other things in the spending program. That's what CID likes to go after. And I'm a little concerned that if you go in this program and that's what your client did, this second bullet might be a problem. If your client appears to have, if there's any hint that their client might look bad, right? It might look bad for your client. It might appear abusive, various other things. It might appear they should have known better. They might want to seek legal counsel coming into the program, right? That's a concern because not waiving criminal prosecution is a big thing here. And I'm a little concerned with how much data we're giving them, and they still have the right to criminally prosecute. So be aware of that. Now, that said, I don't expect they're going to criminally prosecute in most cases. It's going to be a rare case, but you don't want your client to be the rare case. They have a frequently asked questions page for this program, right? And coming back with the stick again, the IRS has a table of penalty that they might assert against those who play the audit lottery and lose. You don't go into this program, you think I'm just going to wait it out. They probably won't examine me because they can't get through all these, and you lose. Well, the IRS is threatening that if you go that route, and again, this is saber rattling, no question, but they have a nice long set of penalties that you might be involved. They remind you're going to have interest, right? And at interest rates from 8 to 10% right now that varies quarterly. You're going to argue for the failure to pay penalties. You're going to argue potentially for failure to file penalties that could be involved. Failure to deposit penalties could be involved. That's most likely true if you did on the original 941. The 20% accuracy related penalty, the civil fraud penalty at 75% of balance due, failure to file penalties combined with failure to fraud. Well, failure to file penalties combined. Oh, good. That fraudulent failure to file penalties, to say, combined with failure to file penalties, which could be 75%, 15 to 75%, and then a trust fund recovery penalty. And that last one they're asserting, and that's interesting. I think it's going to be much easier than to make that claim if it was claimed on the original 941, if it was claimed on 941X. But remember, this offset, you didn't pay in any of the trust fund money either. If you got this credit, it offset that liability. Well, now that could mean, does it count amended return if you got it back? Obviously, that threat is going after personal liability, even if the ERC was claimed inside of a corporation or LLC. So again, the program is open through March 22nd. Certainly, in one sense, it's a really good deal because no interest, no penalties, and you get to keep 80%, and you get to keep 20% of what you were paid. That could help you recover from having paid the third party. And there's no question that you're not going to anywhere near that good a deal on exam, right? The point is they're not going to cut that deal for you on exam unless you have a case that's at least good enough where, there is a risk of going to court for the IRS. They don't see it as being totally off the table. But again, the interest won't be waived in that scenario anyway. So, yeah, you look at this, and this is a really good deal, you know, unless your client can qualify for the vast majority of the ERC in the quarters in question. So, but the problem is they have to have the money and they have to give up all the ERC. So it's one of those where you do it and you make a call. I wouldn't just tell a client, if you haven't studied their case, I would not tell a client to just jump into this program. Because again, they're giving up all ERC, and that's potential liability. If you advise somebody, oh, just go in this program, you don't want to mess with it. I would tell the client, look, you probably should have me review this. I understand there's a time crunch, but I didn't file this for you, so you have to live with it. But the smart thing to do, if you really are concerned, if you really believe it's totally flaky, then you can go ahead and go into it. I would say, though, in order to know how flaky it is and whether you qualify for any of this, we need to do a separate study, and we need to take a look at the whole issue on its own. But all of that has to be done by March 22nd. So clients may have to make a call on imperfect information. Just be aware of that. But I wouldn't just flat out advise every single client to do this, who applied for an ERC, because there are definitely clients who may have been overly aggressive with their ERC, but still qualified for some. Because the mills were just looking at processing things as quickly as possible in many cases. So they wouldn't have necessarily taken time to properly handle a case where, the client qualified clearly. They'd have just used their standard, whatever excuse they were using for, basically a full suspension for every quarter, and filed a claim. That's where it's a tougher call, and that's where it's a tougher deal to deal with. Those clients need to resubmit amended claims, but you have to realize when you look at what they'd have to pay back, the interest and other issues, there may be a chance that they'd still be better off going this route and giving it up entirely. So that's a lot of work to do, and unfortunately, we only have 3 months to do it. So be aware of that side. The IRS was in a gift-giving mood. We're here in the holiday season, so apparently going to do some more gifts. Those 2024-7 issued on December 19th. The IRS, as you may remember, suspended sending out balance due notices based on the COVID-19 emergency. And what happened was, as you may remember, they were shut down. They weren't processing, they weren't processing things very quickly. And AICPA and others started complaining that, wait, you got these automated notices going out all the time, getting more and more threatening. And, people are just, we can't get a hold of anybody. You're way behind in processing stuff. You need to stop sending these letters that are just upsetting people. And the IRS agreed to do that. And on February 9th of 2022, they issued news release IR 2022-31, stating they were going to stop these automated notices from going out any longer. Right? Now, they did say, because they believe they're pretty much caught up, they're going to begin sending out such notices in 2024 for tax years 2021 and earlier. Right? They're also announcing at that time, this is the program. They're going to say, okay, because we didn't remind you of the balance due, we're going to waive failure to pay penalties that would be imposed over that period where, you essentially weren't getting reminder notices. That's really what this is about. It's only for 2021 and 2020. Their theory is that for like 19 and earlier years, well, you were told you owed the money, you should have known it, right? In essence, that there should, at this point, you shouldn't necessarily need a reminder notice. But if it was 2020 or 2021, the notice went out, said, please pay us, but you didn't get any future reminder notices. They're saying, okay, you might have forgotten now, etc. We're going to go ahead and we're going to waive this penalty. To be eligible, you must be assessed income tax for taxable years 2020 and 2021 as of December 7th, 2023. It's got to be less than $100,000 that was assessed, right? Excluding any Apple additions to tax, penalties, or interest. So you were assessed less than $100,000 of tax. It is the first requirement. You had to have received initial balance due notice, including but not limited to notice CP14 or CP161, on or before December 7th of 2023 for taxable years 2020 or 2021. And you must otherwise be liable during the relief period for accruals for addition to tax for failure to pay under either 6651A2 or 6651A3 with respect to an eligible return for taxable year 2020 or 2021. Now, the eligible returns, generally most individual returns, right? So we're talking about standard Form 1040, Form 1040C, U.S. supporting alien income tax return, 1040NR for the non-resident aliens, 1040PR, the Puerto Rican form, SR, return for seniors, right? Those would all be ones you're involved with, and SS, the U.S. self-employment return form 1040SS. There also are most entity returns are in this mix too, that balance due. Includes trusts, estates, taxable corporations, and tax-exempt organizations. So the 1120 series, for the most part, and there's a whole slew of 1120 forms, as we all know, that are involved. Well, the 1120 series, for the most part, is fully eligible. We'll get all the various things, the homeowner association, life insurance company, all those other various things that are in there, and basically pretty much all of them are there. Not going to read through them in detail because we all know they go on for a while. Fairly, the ones we're most concerned about are 1120 itself and 1120S, which are the big ones involved. We also have the Form 1041 and a couple of related 1041 forms, as well as the 990T exempt organization business income tax return. And all of these will have failure to pay suspended, essentially during the eligible period. Right? That period for suspension, it begins with penalties that would have applied on the later of, beginning on the later of February 5th of 2022, or the date you got the initial balance due notice, and ending on March 31st of 24. So again, it's going to run through March. So if you get that all paid, you'll get out of all those penalties. So that'll be part of what you're doing. Now, there are a couple of exceptions they note here. They say, first, it only covers the returns listed and the items listed. So make sure don't use it for other things. It doesn't work. Does not apply if you enter into an offer in compromise or a closing agreement. Both of those are agreements that set the entirety of the balance. So because of that, if you enter into a closing agreement or an offer in compromise related to 2020 or 2021, this is not going to impact or change that. Finally, we have a court case this week. Nijen, I got that wrong, and I apologize to the taxpayer, versus Commissioner, Tax Court Memorandum Decision 2023-151. It came out on December the 20th. Now, this case involves IRC Section 7502, which is the timely mailing, timely filing section we're used to. And specifically, it's going to involve 7502F. This involved when Congress went and added to saying, okay, we know certified mail, registered mail works as, and under the regs, the exclusive proof that you actually filed the return. Well, they decided to add certain specified private delivery services. And this is 7502F. But it allows them to do specific services, not companies, that qualify for treatment like certified and registered mail. And the problem we're going to get into here is these companies offer many services. Not all of them will qualify for this purpose. Right? Now, notice 2016-30 is the current one. It was current for this case as well. And it has a list of specific services from DHL Express, FedEx, and UPS that qualify under this private delivery service exception. So you can file these documents from various locations. And to be honest, especially if you're overseas, DHL Express, FedEx, etc., may be the best way to get it filed, because you can't really walk down to a U.S. post office and get certified mail. It's not going to necessarily be simple to do. So these provide options there. In today's case, though, our specific problem is FedEx does not include the FedEx ground service. That was not one of the services that the IRS said, hey, they count. And you all know that FedEx is the one that has the X in green on the trucks that deliver it. It's a ground service. It was established mainly to compete with the standard UPS type services, and that's the purpose of the service. Now, the taxpayer's petition was actually delivered to the tax court by FedEx Ground one day after the last date for filing a petition. So obviously, he had given a petition to FedEx prior to the filing deadline, but it actually arrives a day after the deadline. And the arrival date's important here because if, in fact, you don't meet 7502, then the date it's deemed to be, basically, it has to actually make it to the tax court, physically arrive by the last date for filing. And this arrived 1 day late. So now we have a problem. But the taxpayer said, no, we shouldn't have a problem. Because while they agreed that FedEx Ground was not listed, that's kind of hard to deny. There's a list here. It's not on that list. The taxpayer argued that FedEx Ground was substantially identical to FedEx 2-day, which is on the list. By the way, you don't have to use overnight, right? You can use second day. For both FedEx and UPS, they have second day services on the list. So, you can, and you'll get the same protection. So, I mean, a lot of people hear that, about these alternate delivery services. They just, in their mind, automatically go to the overnight service. I need to get it there right away. Nope, you just need to get there on the service that's listed and meets the tracking requirements. Now, I wouldn't doubt that he was told by somebody, well-meaning somebody, at a FedEx location, you don't want to pay the extra money for FedEx 2-day. Really, FedEx Ground gets it there at the same time frame. It's virtually identical to it. It's like, no, why do you want to pay extra? Well, unfortunately, people behind the FedEx counter are not trained tax professionals. And if you're got to tell your client if they want to use the FedEx person, they have to understand that, you're going to tell them the services they can use. And I don't care how great a deal the FedEx guy in the back behind the counter tells you this other thing is, and it'll work just as well. Don't use it. It's got to be on the list, right? That's going to be the important part of this. Taxpayer argued, well, since he used something that was the practical equivalent of the second 2-day, he should still get to use the timely mailing because, picky little detail here. It shouldn't count against him. The tax court disagreed. Even if we accept that FedEx Ground is substantially identical to FedEx 2-days, and they didn't say it wasn't, they said only the latter, only basically the FedEx 2-day is actually on the list. And the service has to be on the list. A great example of this is a case they mentioned in the actual opinion. The first case back in early 2000s that I remember coming out on an issue like this, this was back after the IRS had put out their initial list. And sometime after that list came out, FedEx added first overnight. First overnight is, you just take a look at your FedEx services, is the most expensive service, and it swears it will get it to the location by 8 a.m. the next morning. The only problem was because that didn't exist when the IRS got the first list together and asked companies to submit, services that would qualify, meet the requirements. FedEx first overnight was not on the list. So despite using the most expensive FedEx service possible, the initial case in this area said it wasn't on the list, it doesn't count. Your thing arrived by 8 a.m. the morning after the last day for filing, so you're out. That meant pretty much the same thing here. This is not a fairness deal or a, does it make sense deal. This is simply Congress wrote the law, and Congress said in order to meet this requirement, you have to use a service that the IRS, as specifically identified as being a service you can use. So that creates a problem for us. So, this is a congressional, the language limited to treatments to services the IRS has identified, and clearly the IRS has never identified FedEx Ground. We can get it. So that's not going to help you in this case. Now, there is one little kind of detail here that the court deals with in a footnote that you might have thought. You may remember this. Now, this case would be appealable to the 10th Circuit Court of Appeals. And that's important because you may remember that we talked earlier about a case of Culp versus Commissioner out of the 3rd Circuit. The 3rd Circuit said, looking at a recent Supreme Court ruling, that said that the tax court had the ability to use equitable relief, or would believe in that case it was for collection filings. It wasn't a hard and fast date that you had to file by. The 3rd Circuit has said, we believe based on this ruling that the same should be true about any of these standard, we talk about, notice of deficiency claims where you do the 90-day letter filing. If a taxpayer was, didn't meet the deadline, but could meet equitable relief. That is, it's unfair not to allow them to do it. It goes against equity. If they can establish that, then they should still be allowed to move forward. That was a case of culp. Now, the tax court has already had a reported decision we talked about that they are not going to follow this outside of the Third Circuit, right? In essence, they will file it in the Third Circuit because they have to, but they're not going to follow it outside the Third. So that means the court concluded, and the court pointed out here the 10th Circuit had multiple times ruled that the filing deadline was a absolute statutory requirement. Now, I should note, I don't believe the 10th Circuit has ruled since that Supreme Court case came down. So I think the tax court's confidence in the 10th Circuit, not allowing the filing, it may be a little misplaced, but it is their position. So in theory, if let's say somebody took this up for this taxpayer, they could go to the 10th Circuit, seeing if they could get equitable relief. The problem is I'm not sure how, what great shape his case is in, and whether or not it would make any sense to basically spend the money to try to go forward. I would think, since this was a pro se case, it appears that basically probably the case is garbage and it's not worth the spending. I think the first time we're going to see the culp case attempt to be pushed, the boundaries of culp, will probably be when legal counsel somehow fouled up a date. And then we'll see it come in, where they're looking to try to cover themselves, to say, yeah, we still filed on time, right? We still get the filing. So I wouldn't see this one being pushed forward, but I do expect, watch somewhere in the future, somewhere in 24, I wouldn't be surprised to see a case, an attempt in at least a few other circuits to get a culp ruling on the books. Well, this finishes 2023 for current federal tax developments. Hopefully you've had a good and wonderful year. Hopefully you're enjoying your holidays and basically your last time off before tax season. That also adds a lot, so got to do that. In any event, we'll be waiting for you when we get back to 2024. So enjoy your Boxing Day and enjoy the other things that may be going on the next week or two as we get ready for the brand new year. And we'll see you next week here. You can still email me, edzollers@currentfederaltaxdevelopments.com, for the quick question. I also follow the posts on the Connect sites for Arizona, New Jersey, Minnesota, Illinois, Washington, and I do take a look over at what gets posted on the Idaho site, their discussion site, which is not Connect, so it's a little bit different structure. Also, I do post my updates on the website, currentfederaltaxdevelopments.com, when I write things up. And I usually mention developments as they happen, and I'll flag them even if I don't have time to write them up, on my account on Threads, at Ed Zollers on Threads is a place to follow. Otherwise, as I say, we will see you here next week for more in the area of current federal tax developments.